The American dream of homeownership is rapidly becoming a financial nightmare as economic pressures signal an imminent housing market correction. While some headlines suggest a soft landing, hard data reveals a fractured market with an illusion of stability in some areas, masking accelerating price declines elsewhere. Portending a downturn every home buyer and investor must understand now. Welcome. Today we dive into the precarious U.S. housing market of May 2025. Whether you're buying, selling, or investing, this information is critical. We present an analytical view based on the latest statistics. The ground beneath the housing market is shifting. For years, relentless home value climbs were fueled by low interest rates and buying frenzies. Now, the music is stopping. Let's examine mortgage rates. As of early May 2025, 30-year fixed mortgage rates hover between 6.5% to 7%, a range seen since early spring per CNET, Forbes Advisor, and Yahoo Finance. Yahoo Finance reported a 6.7% rate on May 3rd. This sustained high-rate environment stems from the Federal Reserve's caution. The Fed didn't cut rates in early May, citing economic uncertainty, inflation, and trade complexities, as CNET detailed. Markets anticipated 2 to 4 rate cuts in 2025, but borrowing remains expensive, far more than during the pandemic boom. Experts cited by CNET deem sub-3% rates unlikely without a severe economic downturn. This high-cost borrowing creates a lock-in effect. Homeowners with low rates are disincentivized to sell, constraining existing home supply and complicating market dynamics. Now, consider housing inventory, which shows alarming signals. For a long time, a severe lack of homes drove prices up. Now, the landscape is changing. According to ResiClub Analytics, national active listings surged 30.6% year over year. This significant shift indicates home buyers are regaining leverage. Homes sit longer, a sign of cooling demand amid affordability challenges. Despite this surge, April 2025 national active inventory was still about 15.6% below April 2019 pre-pandemic levels. Inventory is building, and ResiClub projects it could approach 2019 levels in late 2025. This increase is more about homes selling slower than a flood of new listings, though the new listing drought might be easing. Regionally, as of April 2025, 9 states, including Florida, Texas, and Arizona, have inventory above 2019 levels. These markets, especially in the Sun Belt, which saw dramatic pandemic price run-ups, now face corrections with softer price growth or declines. HomesForHeroes.com noted total housing inventory at 1.33 million units, up nearly 20% year over year. Newsweek reported new home inventory at 503,000 in March 2025, an 8.3-month supply, typically a buyer's market. This swelling inventory, especially in formerly hot markets, is a red flag, forcing sellers to compete, cut prices, and cede market power. To illustrate, consider Phoenix, Arizona, once a poster child for explosive growth, now seeing active listings significantly above its 2019 benchmark, leading to increased seller concessions and a palpable cooling in buyer frenzy. Similarly, in Austin, Texas, a market that ResiClub Analytics has highlighted for sharp inventory increases well past pre-pandemic norms, the impact of tech sector adjustments, and a surge in new construction completions has left sellers scrambling. We see similar trends in parts of Florida like Cape Coral or Punta Gorda, where inventory has ballooned, putting downward pressure on prices that had previously seemed unstoppable. Even Denver, Colorado is reporting inventory levels that offer buyers more choice and negotiating power than they've had in years. This isn't just a coastal or Sun Belt phenomenon in isolation. It's a pattern emerging in markets that overheated. Contrast this with a market like Chicago, Illinois, or parts of the Northeast like Hartford, Connecticut, where inventory, while perhaps slightly up, remains stubbornly tight compared to pre-pandemic levels, creating a different set of challenges and sustaining seller leverage to a greater degree, at least for now. However, the national momentum is towards loosening, and even these tighter markets are not immune to the broader chilling effects of high rates and economic uncertainty. The combination of high mortgage rates and rising inventory levels naturally leads us to the critical issue of housing affordability. According to First America's Real House Price Index for February 2025, affordability nationally saw a slight statistical improvement, with real house prices decreasing 0.6% year over year due to slowing price appreciation and income growth. However, Newsweek reported housing affordability fell to its lowest since 2020. The Mecklenburg Times highlighted homebuyers now need to earn about $47,000 more annually to afford a median-priced home than 6 years ago. First American noted that by February 2025, nominal house prices dipped below peaks in 47 of 50 top U.S. markets. Austin, Texas saw prices fall 10.7% from its May 2022 peak. San Francisco saw a nearly 10% decline from its April 2022 peak. For instance, beyond Austin and San Francisco, other pandemic darlings are feeling the chill. Boise, Idaho, which saw some of the nation's most extreme price growth, is now grappling with a significant recalibration as buyer demand wanes and inventory sits longer. Sellers in Boise are increasingly forced to slash asking prices, a stark reversal from the bidding wars of just a couple of years ago. In Florida, while the RHPI data from First American indicated improved affordability in cities like Tampa and Orlando, this often translates to prices coming off unsustainable peaks. Tampa, for example, saw a 15.8% year-over-year decrease in its real house price index as of February 2025, signaling that the rapid appreciation has hit a wall and in some segments is reversing. Even markets once considered more stable are not immune. Take some of the rapidly growing southeastern cities outside of Florida. Atlanta, Georgia also registered a significant 9.6% decrease in its RHPI, indicating that affordability pressures and rising inventory are forcing a market correction there as well. These are not isolated incidents, but rather a pattern of reversion in markets that became detached from local income fundamentals during the low-rate frenzy. The pain is palpable for recent buyers in these areas who bought at the peak, now facing the prospect of negative equity, while investors who chased unsustainable yields are looking at diminishing returns or even losses. While these declines signal distress, many pandemic-era buyers retain substantial equity. The RHPI showed improved affordability in states like Florida and Texas, and cities like Tampa and Atlanta, often reflecting prices falling from unsustainable highs. A May 2025 Gallup poll found 50% of U.S. adults still expect local prices to increase, showing pessimism. Even with new home median prices decreasing 2.32% year-over-year in Q1 2025, often due to builders offering smaller homes, the overall cost of entry remains crushingly high. This affordability crisis weakens demand, pushing prices in overvalued markets down. Delving into property types, particularly single-family homes, Ion Housing reported the median new single-family home price decreased 2.32% year-over-year to $416,900, 8 consecutive quarters of year-over-year declines. This is largely due to builders adapting by constructing smaller homes using smaller lots, offering incentives, and shifting to less expensive regions like the South. Conversely, the median existing single-family home price in Q1 2025 rose 3.38% year-over-year to $402,300, 7 consecutive quarters of year-over-year increases. The new to existing home price gap shrunk to just $14,600 in Q1 2025 from $64,200 in Q4 2022. This shows builders are cutting prices while the existing home market is propped up by the supply-constraining lock-in effect. Regionally, for new homes in Q1 2025, the Midwest was cheapest, $367,500. Northeast, priciest, $784,900. For existing homes, Midwest was cheapest, $297,800. West, priciest, $626,000. Where existing homes were $100,000 plus more than new. Sales volumes are mixed. Newsweek reported new single-family home sales climbed 7.4% in March 2025. NAR reported existing single-family sales fell 6.4% in March, down 2.2% year-over-year. Buyers may be drawn to new constructions with deals. Zillow's April 2025 forecast expects single-family rents to rise 3.1% in 2025, adding financial pressure. This bifurcation creates a volatile environment. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now let's continue. What does this mean for home buyers and investors? Strategies now demand clear risk assessment. For home buyers, the environment is challenging. First, rigorous financial self-assessment is crucial. Understand your true affordability considering economic headwinds. As CNET advised, create a realistic budget and stick to it. Second, rising inventory in markets like Florida and Texas could offer opportunities. Sellers are losing leverage. Negotiate price and concessions. New home prices declining for 8 quarters suggest new construction with builder incentives might be viable. If not rushed, observe price and inventory evolution. First American's data showed prices dipped from peaks in 47 of 50 top markets. Shop aggressively for mortgage rates. Even small differences matter. Consider refinancing if rates fall later, but don't bank on it. For investors, this market requires sophistication. Price declines in markets like Austin and San Francisco and rising national inventory signal easy appreciation is over. For long-term holds, exercise caution, especially in stressed markets. High interest rates erode rental returns. Zillow's 3.1% single-family rent rise forecast for 2025 might not offset higher costs. However, downturns create buying opportunities for well-capitalized investors. Distressed sales may increase. Identify fundamentally sound markets with temporary oversupply. Deep, localized research is key. As national trends mask regional variations, consider strategies beyond buy and hold, like acquiring new homes with builder incentives for rental. Commercial real estate, especially office and retail, faces headwinds but could offer alternatives for experts. Short-term flipping is exceptionally risky. Pay attention to potential interest rate changes. Caution, due diligence, and long-term financial health are paramount. We're entering a significant market adjustment. In conclusion, the U.S. housing market in May 2025 is on a knife edge. Persistently high mortgage rates choke demand. Alarming inventory surges, especially in Sunbelt markets, see prices soften. The affordability crisis remains severe. Divergent property type trends show new home prices falling, while existing home prices are propped by low supply. These interconnected issues signal a market under immense stress. Our opening statements are borne out by this data. For home buyers, extreme caution, meticulous planning, and hard negotiation. For investors, sophisticated understanding of regional variations, focus on fundamentals, and awareness that easy gains are over. The coming months are critical. Whether a gradual deflation or a rapid crash occurs depends on Fed policy, economic performance, and consumer confidence. The housing market of early 2025 is not that of recent years. Risks are higher. Informed decisions are crucial. Prepare for volatility, protect your finances, and stay informed. Thanks for watching. If you found this analysis helpful, please hit that like button, subscribe for more real estate market insights, and share your thoughts in the comments below. Please share this with a friend and watch this one as well.